Hey guys, welcome to my YouTube channel. And today we are going to learn about the fundamental concepts regarding the Kenya's financial market. So let us jump right in. So to start with, you are probably asking what is a financial market? And to understand this, we are going to define what it is. And the meaning of financial market is that it is a platform or a system where individuals and institutions come together to trade financial instruments. And so basically, we are saying that a financial market is just like a normal market where you go to purchase goods and services. But in this case, you are buying financial instruments, which are stocks, bonds, and currencies. So we are saying, given the different types of the financial instruments that we have just mentioned, it was considered wise to then categorize the financial market into segments. Just like you go to a normal market, or let's say you go to a supermarket, and there are segments. So you will find that in a supermarket, there are segments for food items, there are segments for furniture, a section for electronics, and a section for beauty products. So you apply that to financial markets, and then we also have market segments. So in Kenya, we have got four main segments of financial market. So number one is capital markets, and then we also have money markets, and then the third category we have is Forex markets, and we also have another category on derivatives markets. So this screen you are seeing right now here summarizes the meaning of the financial markets and the actual instrument that we are trading, stocks, bonds, and currencies, and then also the categories of the markets in which you can find each item. So let's take this further and understand what is in each market. So let's start with the capital markets, and we can define this as a market where long-term securities are bought and sold. So when we talk about long-term securities, we are talking about stocks and bonds. And when we talk about a stock, we are talking about a percentage ownership in a company. So you buy a stock and then now you become known as a shareholder. So once you're a shareholder, you get to benefit from dividend payments, and you also get to benefit from an increase in share price. So if you buy a stock at 20 shillings today, and then next year it is 30 shillings, so your share has increased in value. And so in Kenya, we have got many companies that are listed in the Nairobi Securities Exchange. So just to give you an example of some of the few stocks that we have include Safaricom, KCB, Kakuzi, Nation Group, Equity Bank. There's so many. And also another type of product in the capital markets is the bonds. And when we talk of bonds, these are ownership or loan that you give to the government. So whenever government needs money for capital intensive projects or just for development, the government will float a bond. So when a government floats a bond, it is inviting the public to come and buy products so that the government can raise funds. Examples of bonds that we have in Kenya, we have government bonds, we have infrastructure bonds, and a lot of other categories. So just a side note to this is that when you want to participate in the capital markets, then you have to have an account that is called a CDS account. And CDS stands for Central Depository System. So you open this account and then you will be able now to deposit money into this account. You'll be able to buy stocks, buy bonds, you'll be able to sell, you will be able to hold, you will be able to monitor what is going on by opening a CDS account. So that marks the capital markets. Now let's go to the second category, which is the money markets. And here we are seeing a money market is a market for short-term debt instruments and securities. So the two main categories that we have here are treasury bills and money market fund. So a treasury bill is just like a bond, but it is short term. That is the only difference. It's like a bond, but it is short term. A bond can go up to 30 years, 20 years, but a treasury bill is short term. It goes for 91 days, 182 days, 364 days. And then we also have money market fund. Of course, MMF. This is like a buzzword today in Kenya. Every corner of the country you go, people are talking about MMF. So we have got different fund managers that are offering different products at different interest rates. We have got examples like Mali, ZD, CIC, Britam, KCB, Equity, Saito. There are so many. And so to participate in the money markets, if you were to buy a treasury bill, of course, you need a CDS account with the central bank. So you just walk to central bank. They guide you in opening a CDS account. On the other hand, if you want to participate in the money market, you don't need a CDS account. Just walk into the offices of your fund manager of choice, be it KCB, be it Equity, Saiton, any insurance company, any investment bank, any bank of your choice, and then they guide you on how to open an MMF account. Go to the third category, the Forex markets. So a Forex market is a market for trading currencies to earn a profit from the price differences called spread. So in the global economic space, there's a way that the currencies interact, and there's a way that one currency is stronger than the other, another currency is weaker than the other. And so this scenario gives us a situation where we get a concept called spread. So if you can analyze the market and take advantage of these noticeable price differences, then you can buy one currency now and then sell it later. So we call this spread. And by doing so, you can actually earn. So you can trade Kenya shillings, USD, British pound, Japanese yen, Canadian dollars, Australian dollars. There are so many currencies out there. You just monitor the market and then you trade. But a side note here is that in forex trading, you don't need a CDS account. But the reality of the matter is that it is high risk venture, highly speculative. You simply need to identify a licensed intermediary, and then you do your analysis correct, and then maybe you get to earn something. So the last category, of course, derivatives markets. And when we talk of derivatives, these are financial contracts that are valued based on underlying assets. And some of the most common products here include futures, forwards, and swaps. And just in case maybe this a bit technical for you, let's take a practical example just to drive the point home. So here in your screen, we have got two traders. We have John on your left side, and we have Mercy on your right side. So John is telling Mercy, hey, I'm John. I want 100 kilograms of wheat in 6 months' time, and I will be interested to buy that at 10 shillings per kilogram. And then Mercy is saying, okay, that's fine. Let us sign a contract to supply the wheat at the agreed price despite fluctuations in future dates. So these are two traders that want to sign a contract to trade in future. So that's why it's called a derivative. It is not for today, it is for future. And now, having signed this contract, there are three possibilities, three scenarios in future. Because they signed the contract at 10 shillings per kilogram, let us see what happens. In case in future the wheat price drops to 8 shillings, then what happens? Mercy is protected because she will still sell at 10 shillings, while John will regret that he missed the opportunity to wait to buy at 8 shillings. He already signed the contract to buy at 10. The second scenario is where wheat price increases to 12. And then, so what happens? John is protected because the market price in 6 months is 12, but he's buying at 10. That is what he signed. So then to Mercy, she's regretting. Why did she sign that contract? So she's missing out uh, on selling at 12 shillings. Another scenario that might ensue is when the wheat price remains the same. So in this case, there's no effect, but at least each party is guaranteed. John is guaranteed that he's going to get wheat for his company, and Mercy is guaranteed that she will be able to sell despite high competition in the market. So in your daily life, in everything that you do, you might be prompted to maybe sign a financial contract. And when you do that, knowingly or unknowingly, you are participating in a derivatives market. So guys, that marks the end to this YouTube video. It was about understanding what a financial market is, understanding what are the options available out there, understanding the core concepts before we can now go to the actual practice of trading. So please, if you found this video helpful, I'm imploring you, I'm urging you to keep checking. Please subscribe, like, comment, share, so that in the next video, we'll be able now to go deep into understanding the concepts of the NSE, the financial intermediaries, regulations by CMA, and how everything just happens. Thank you guys, and see you in the next